Hi everyone, welcome back to Business Studies class. So we have started with banking services, right? There we have seen different types of banks and we have concentrated on commercial bank and we have understood the functions of commercial bank. Then we have seen the merits both to the banker and to the customer with the e-banking facility. There we have ended up the banking service under your business service chapter. The next type of business service for our syllabus is insurance. In chapter 1, we have seen aids to trade, right? Helpers to trade. There we have seen hindrance of risk, isn't it? So the hindrance of risk in the sense when you produce the goods, it might be primary industry or secondary industry, or it can be like trade. Okay, industry side, or it might be on commerce side. When you involve in the activity, always risk involves. What is this risk? It is an uncertainty. Okay, it is happening of loss. Okay, so this risk is an essential part of business we have seen. So it might be risk arises in industry and also in commerce. So that is what the hindrance of risk is. Okay, risk is present everywhere. So because of that risk, if the degree of risk is more, generally we don't want to take up that activity, isn't it? So for that, to avoid this risk or to minimize this risk, we have seen that insurance is helpful. For example, when you transport goods from one place to another, there is a risk of accident or theft in transit or anything else. That is, there is always a risk of losing your goods and worth of money. Hence, if you don't have any security for that, you will decide not to transport your goods. Is it clear? So in order to avoid such a type of risk which is involved in different types of industrial and trading activities, insurance has been introduced. Insurance is protection for a risk. So if someone says that you carry on the work, it's me who will take up the responsibility of protection of your goods. You pay me something monthly as premium. So in times of your need, I'll be there to help you. So this is what the commitment under insurance we generally see. Hence we say hindrance of risk can be overcome or it can be taken away through the help of insurance. So that is what we are going to see in this particular topic. What is insurance? What are the different terms used in insurance? And what are the functions the insurance company will generally undertake, and principles of insurance. So let us start with knowing the meaning of insurance. So when I say insurance, it is basically a contract. Okay, a contract between two parties. Okay, that is the company assuring in the contract of insurance to compensate is known as an insurer. As I said, it is the insurance company which is known as insurer, and the person who has taken the insurance for his goods is called insured. Is that clear? So insurance is a contract between two parties, entered between two parties, where one party says that you pay me something on monthly basis which is called a general fee or premium, for which I'll protect your goods if something wrong goes with your goods. Is it clear? So we say it is a contract between two persons, that is the company assuring in the contract of insurance to compensate is known as insurer or assurer, while the person to whom such assurance is given is known as insured, that is assured. It is the assured or insured who pays premium to the insurer. In this contract, the insurer is liable to compensate for the specific loss to the insured who has paid regular consideration, that is insurance premium. This is called consideration or fee, or as a insurance terminology we use as insurance premium. So simple. It's me who want to carry on the business activity, but always I have a risk. So some other party gives me an assurance that if you pay me regular premium, I'll get you protection of your goods if something goes wrong. Is it clear? So that is what a simple meaning of your insurance. Here you can see something better. A contract where an insurance company undertakes in consideration, that is for some fee, of regular payment of premium to pay a certain sum of money to the assured on maturity of a policy, death, whichever is earlier. So it is purely about life insurance. When I say insurance, there are two different types of insurance, that is life insurance and general insurance. The insurance what you take for your vehicles, your property, we call it as general insurance. All those comes under your general insurance. You might heard about fire insurance, health insurance, right? And regarding property insurance, you might heard about insurance taken on particular goods. Okay, so all those comes under what? Your general insurance. But when you take insurance on your own life, it is called life insurance. Okay, so this definition is purely concerned that a contract wherein an insurance company undertakes in consideration of regular payment of premium to pay a certain sum of money to the assured on maturity of policy or death, whichever is earlier. See, the major difference between life insurance and general insurance is, okay, now you are the insured, means you need protection. Okay, you are the insured, you need the protection, for which you are going to an insurer, the insurance company, and seeks an insurance policy saying that I have a particular goods, for that I need security. I'll pay you monthly amount. Okay, you will pay a regular premium. For example, for vehicles and all, you will be taking insurance, vehicle insurance. So yearly once we will be paying premium, and within that year, if something uncertainty happens with your vehicle, the damage happens, if something damage happens to your vehicle, they calculate the damage and according to that they'll pay you the money. Is that clear? So you might take an insurance for 1 lakh rupee and monthly you might be paying only 1000 rupee. Okay, the insurance policy value is 1 lakh rupee. Okay, and monthly yearly you will be paying only 1000 rupees. So if something goes wrong with your vehicle, then they'll calculate the loss. So what is the damage? If it is 80,000, they'll pay you 80,000. But how much you paid per year? Only 1,000 you have paid, but insurance policy you might taken for 1 lakh, and hence they'll value the damaged vehicle, and if it accounts to 80,000, they purely pay you 80,000. In that case, you got the loss. Your loss is compensated by the insurance company. It means you are shifting your loss to the insurance company. Opposite situation we take. For example, you have paid yearly 1000 rupees, policy you have taken for 1 lakh rupee. Okay, nothing happened. You are good. Your vehicle is in good condition. Nothing happened. Okay, then you don't get anything from the insurance company. Only if uncertainty happens, then you will be getting back the amount what you actually suffered, loss. Is that clear? If it is in the case of general insurance, but in case of your life insurance, two conditions. One, the date of the policy should be matured. It means it should be completed, or else the death of a person on whose life you have taken policy should happen. In both the cases, you will be getting the sum assured, that is the policy value you will be getting back. For example, on my life, I have taken insurance policy of rupees 5 lakhs. Okay, so yearly or monthly I will be paying premium. Okay, and that is for 5 years. Okay, 5 lakhs policy, 5 years I have taken. So it will be two cases now. In general insurance, loss should happen, then only they'll compensate for the loss. But in life insurance, what happens? Loss may not be there, but the time period may expire after 5 years. So by God's grace, I am okay. Okay, I have completed the policy period of 5 years, then I'll get back the amount of 5 lakhs. What is sum assured? And yearly or monthly, I might paid only 4 lakh rupee totally, but I'll be on maturity of my policy, that is on completion of the policy, I'll be getting back 5 lakh rupees. That 1 lakh is a profit what you made on your policy. This happens only with your life insurance but not with general insurance. In case of general insurance, only if you suffer loss, then the company, insurance company, that is the insurer, will compensate the loss, and if not, nothing will be paid to you. So this is the difference you have to remember about life insurance and general insurance. Let us move towards the some terms in your insurance, like insured, insurer, premium and policy you have. As I said, insured is the one who is getting compensated, or else you can say the one who pays the premium. Anyways, okay, it is me who is paying premium. It means I am the insured, means I am secured. I am assured that if something goes wrong with me, I will be getting money from the insurance company. That's what I am called, assured, insured, or the one who pays the premium. The company that agrees to pay the compensation is known as insurer or assurer. Okay, so I have paid premium to a company, and the company gives me an assurance that if something happens to you, or after the maturity of the period, I'll be giving you this much amount. They have committed for that amount, so they are called assurers. That is what, insurer. So insurer and assurer, always the insurance company. Okay, the money that is paid by the insured to the insurer on periodical basis regularly up to the period of maturity is called your premium. This is the consideration or the premium for which the insurance company actually works for. Okay, so I told you the premium will be paid regularly. Only if loss happens, your money will be back as per assured. How much they have given you assurance, that much amount you will be getting back. Only if the damage happens in case of general insurance, but in case of life insurance, the damage may or may not happen. For example, I have taken life insurance, I am speaking about. I have taken life, so I may be okay. Then after the period of maturity, I will be getting back. If the insured dies, expires within that period, the entire amount, irrespective of the premium paid by you, the entire amount what is assured will be given back to the descendants of that particular premium paid person, that is insured. So these are the three terms. One more you can add as insurance policy. So that is a contract between the insured and the insurer. Now you see the functions of insurance. What actually insurance does? Here you can understand. It provides certainty, it provides protection, it shares risk, it assists in capital formation. These are the four important functions undertaken by the insurance companies. First one, if you see, providing certainty. It provides a certainty in the sense, I told you that it provides it says that if you suffer the loss, it's we who give you the compensation. Means it's we who are ready to compensate your loss. With that confidence, what happens? You will start doing any type of business activity. Is it clear? Many people don't come forward to do a particular business activity because they know that the risk involved and if they may lose some of their money. If such certainty is given by some of the insurance companies that if you face the loss, it's we who are going to pay on sure basis, then many will come forward to do a business. That is what we say, it provides a certainty of compensation. Then protection. Yes, when we say life insurance, it gives complete protection to the insured. See, it says that if something happens, it's we who are going to protect you at the time of inconvenience. See, for example, you might heard about health insurance and all, right? So when they go for operations, major things and all, it is the insurance company who pays for that operation. Actually, we may not pay so much of premium, but we take so much of benefit. So such type of protection is given by the insurance companies. Protection of life and protection of goods also. Then comes risk sharing. That's what I told now. Actually, it is you who has suffered the loss, but when you have taken insurance policy, you are shifting your risk from you to the insurance company. Say I am riding a vehicle, it's my own vehicle, okay, so I met with an accident, some 30,000 of damage has been happened to my vehicle. So now I am just shifting this burden to the insurance company, that 30,000 is paid by the insurance company to me. Hence what happens, I am sharing the risk, my risk with the insurance company for a premium called, for a consideration called premium. And last is assistance in capital formation. See, when I say life insurance, actually many will go with this option, insuring their lives. Then what happens, the insurance company will collect the capital, and that capital, just like a bank, they start investing those funds in the business. See, we know that business needs funds to do their business activities. So from where they get the funds? It is from the banks and also from the insurance companies. Insurance companies, they collect the premium from, it might be life insurance and general insurance, but in general insurance the premium paid by the parties will be less, but in life insurance premium paid will be more. Hence lot of money will be collected by the insurance companies, and that money, what they'll do, they start investing in the business. So when these insurance companies invest in the business people will be getting capital in order to start and to run their business. In that way, insurance companies will assist in capital formation of a company. Capital formation in the sense getting required capital. Okay, so these are the major functions carried on by your insurance company. So one more, just you go with the headings, you be familiar with the headings. So these are the 7 principles. Right, when you want to enter into insurance contract, what you should know in basic. See, principles are called like they are the framework, or they are the like guidelines, we can say. Principles are the guidelines. So one should know what actually insurance involves, what type of guidelines the insured and the insurer should know. Okay, so these are the 7 principles for the insurance, we say. That is like principle of utmost good faith, principle of insurable interest, principle of indemnity, principle of contribution, principle of subrogation, principle of loss minimization, or it can be principle of mitigation of loss. Okay, then principle of causa proxima. So these are the 7 principles. You please go with these 7 principles. Just at least you try to be familiar with the headings, so that in next class we'll take up each one of them, and we'll try to discuss about these principles. Okay, so in today's class you have seen the meaning of insurance and the different terms and also the functions of insurance. Take the help of your textbook and notes, so that it will be clear to you. Okay, so next class we'll meet with principles of insurance. Till then, take care. Bye.